Tools. What are the tools of monetary policy? Anybody remember? What is open market operation?
Buying and selling of securities.
Open market operation. Number 2.
Interest rate, cash reserve ratio, and
cash reserve ratio and SLR.
And rate requirements. Rate requirements.
Rate requirement.
Repo and reverse repo.
So banking.
That is another separate part, but yes, reverse repo. But before that, there's something else.
So bank rate.
Bank rate. Bank rate has two subcomponents in Indian context: repo and reverse repo. We saw reverse repo and repo has been revised yesterday only.
Bank rate means the rate at which commercial banks borrow from the RBI.
Yes, that's right.
So, sir, isn't it different from repo and reverse repo?
Yes, it is different. When you do bank rate in the US and all, US, do you know what it is called? Federal fund rate. Federal fund rate, the basic concept originally is that another bank needs some extra liquidity. It goes to central bank and borrows the money. That is the rate. In Indian context, we do not encourage banks to come to RBI. So whenever banks need any money, they need to come with the SLR security. In the US, you don't have to bring any security. You can straight away go to the bank, central bank, and ask for money. That's one big difference, which is Indian system versus, say, European or the American system. So in their system, you don't need any kind of a bond to borrow money from the RBI. So that's why, so in India, there's a peculiar thing is SLR. What is SLR? Liquidity ratio, which basically means every bank is required to hold a certain proportion of the deposit in terms of the RBI approved securities. There are 100 plus odd securities in which you can invest, and that's about, you know what is SLR? I think I don't know if I showed you last year. 25%. And this is again peculiar to India. So actually banks are already holding 25% of the asset into SLR, and that basically SLR you meet every 2 weeks. So in between, if you need some kind of a fund requirement, since the bank rate channel is not available in Indian context, and so that's why we have created another system which is repo and reverse repo. So that is the way it works. I hope that's clear to everybody. What is the difference? So in Indian context, bank rate is not a tool, but theoretically that's but it has emerged from the same tool, but slightly modified version.
So what is the relevance of bank rate in India?
It's basically irrelevant. Because in India, RBI thinks any bank was coming to borrow from me without having any bond or anything. It's somewhere the bank has a problem. Which means there will be investigation on with the bank which comes for borrowing in the bank rate channel. So in India, no bank really uses this channel.
But what do you mean when you say that RBI discourages banks to borrow without securities? I mean, there is a bank rate prevalent in India.
Yeah, but that's just for a kind of on paper basis, but it's not used in practice. And if you see the bank rate table, if you remember, from 2003 onward, it has not been touched. Even today, last 2 years of recession, bank rate is not touched, CRR is increased, SLR is increased, open market operations are resorted to, repo, reverse repo is changed, bank rate is not touched. And I can show you right away.
6 to 6.
So I can't show you because the net is again very slow. It's not working. So basically, these two data are available from 1935 in India. The RBI table that I was about to show you. Open market operations actually are almost available on daily basis, but that's not reported in the handbook of statistics. That's reported on there's something called RBI weekly supplement, which comes every week. There are about 4 pages of kind of a small document which gives you all the kind of daily kind of things RBI intervening in the market. And what does the open market operation does? It actually helps you to increase or reduce money supply. So if RBI sells a bond to the public, will it increase money supply or reduce money supply?
Reduce money.
Suppose you buy a bond, you will give me cash and central bank. So money in the system reduces and vice versa. So that's how also you can sterilize or kind of increase the money. Like when the foreign exchange reserve comes in, or foreign exchange or FDI, FII comes in, what happens? Dollar came in, so you have to give them the domestic currency, money supply goes up. So money supply can go up not just only because government has a deficit to finance, but also when the FDI, FII comes in. That's why that also creates an inflationary pressure in the economy in the short run. And in the long run, we don't know where the investment is going. If it is going for a sector which is kind of a infrastructure or something, then maybe over time the inflationary effect will be dissipated. It may not have such a significant inflationary impact. Is this clear? So these are basically monetary tools. So if you really have to kind of so this is the rate of interest, this is money supply. We need to also find out what does the money supply curve looks like. For that, we need to first define in the economic context what is money. Did I discover M0, M1? No. So let's go there. So M0, there are different measures: M1, M2, M3, M4, and the most relevant are M1, M0, M3. M2 are again India, peculiar to India. You will not find them in other countries. In most of the countries, M3 is referred to as M2 because there is no M2 in India. So when you go to IMF data, there will be only M1 and M2. And M2 basically means in Indian context M3. So there are names for these. This is called the base money. This is called narrow money. And this is called broad money. Base, or it's also known as the reserve money. Now you can see the way the classification is done. It is the most liquid, little less liquid, little less liquid, little less liquid, little less liquid. So liquidity keeps going down. So how do we define money? So money, as we saw, has four functions. What are the four functions? Store of value, unit of account, medium of exchange, and legal tender. Now, these different ones satisfy different conditions. Like M0 satisfies all the conditions. M1, what is M1? And M0, let me define what M0 is. M0 is all the currency with public plus all the currency with banks and RBI, which is basically reserve. How is it defined? I'm not able to show you the RBI website, otherwise I would have shown you. The net is gone again. So I don't need this basically. So basically, currency plus all kinds of cash, which is the bank or bank have an account with RBI. That is reserve. That's your currency for reserve. Then M1 is C, currency is public, plus let me write here. M0 is C plus R. M1 is currency plus demand deposit plus other deposits. DD is demand deposit. OD is other deposits. Other deposits means the banks have a kind of a deposit with the Reserve Bank of India. So that's again liquid, which they can withdraw at a short notice. And what is DD? DD is not demand draft.
Current account.
The account with the bank or banking system as a whole on which you can write a check. Now, rest I think you can figure out yourself. One of the accounts in which you can write a current account and savings account. Then comes your M2, which is again India specific, not in the other countries of the world. It's M1, post office savings deposit on which you can write a check. Both of them don't have current account. They have only savings account, and on which they allow you to have a checkbook. And N3 is N1 plus time deposit. TD. Time deposit is basically fixed deposit. when you have fixed deposit, it's called time deposit. And M4 is M3 plus post office time deposit. That's the definition. Now you can see, when you're doing any analysis for the business, for yourself, or if you're an RBI doing the policy making, which one should we choose to control? C is directly in RBI control, currency. But see, why do you control multiply? That also will be clear in a short while. But the thing is, now suppose you have to draw a rate of interest and multiply line in this page. Suppose you draw a line for M0. What does it look like? It will be a straight line, not an influencer rate of interest. RBI not affected by rate of interest, how much to print or not to print. But if the interest rate is positive, what do people do? Suppose you have cash in your pocket, and then option, either you keep it cash with you or you put it in a bank. What do you prefer to do? You put it in a bank. So if the moment you put it in a bank, suppose 100 rupees go to a bank. Suppose it's what is the bank nearby here? I don't know, your bank. Say Axis Bank. You have 100 rupees. Take a simple example, and assuming that the CRR is 10%. And other things we are not bothered about SLR now. Just very simple model. You have 100 rupees, you go put it in the Axis Bank 100 rupees. What does the Axis Bank get? 100 rupees deposit. There is 100 rupees in the system. Now our Axis Bank will do what with this? 10% will go to RBI. So 100 are printed by RBI. You have got it, you put it in the bank. So bank gets 100. And what the bank does? 10 it gives to RBI. And 90 what it will do?
Lend it. Not
it will lend out. The moment you lend out 90 rupees, what the other person will do with 90 rupees? Who are borrowing? Either they will spend it or they will put it again in the bank. If whatever they do, ultimately come back to the bank. Because if you spend it, the guy who is taking it again will put possibly in the bank. So the next step, again, 90 rupees will come. In 90 rupees, 9 will go to RBI, and here the bank will end 81. And this process will go on. Again 81, 8.1, and whatever remaining, 17, 22.9. So and this process will go on. And you find RBI if you add 10, 9, 8.1 and all, this will equal exactly to 100. And what is this will be equal to? 1000. This is known as process of money multiplier. Money multiplier, also known as sometimes another name, credit multiplier. So you replace credit here also, or money multiplier. I hope you understood the process, how banks can multiply money. So legally RBI printed only 100 and RBI got 100 rupees back. But the system now has equal to 1000 rupees. Now the question comes, when will this not work? What are the conditions under which this multiplier will not fully work? So what is the multiplier here in this simple context? 10, isn't it? Why 10? 1 over CR. That's how the multiplier came. Everything, and the moment I make it 5, the multiplier will be, instead of 10, 1 over 0.5 will be 20. I make 20%, the multiplier will be 5. And if you see the Indian data, presently, the N3 divided by N0 is roughly equal to 5. What should the multiplier be? Our CRR is about 6%. It should be way higher, isn't it? Why is it not that high? N3 divided by N0 will give you multiplier. Or M1 by N0 will give you multiplier. M1 by N0 is about 2. Very small. Because in this, you cannot lend a lot of money from this. Because this is, you have to lend it, you have to keep it, lot of it, cash with you, because current deposit means people will withdraw very soon. Saving deposit people means they will withdraw maybe by month end. But time deposit is something which is available for you for a long duration. And that's where the multiplier normally works. And if you see over time, this component is now becoming bigger than this component. It's quite obvious because this by this is about 2, but this by this is 5. So obviously this component is over time. And when will this component grow? When people trust the banking. Trust is very important. That your money will be safe. And how will you get the trust? In Indian context, you got the trust through nationalization 1969. Or other way of getting trust is from regulation of the banking system. Basel 1, Basel 2, Basel 3 and all those things. And third, what is the role of the RBI in case there is a crisis? RBI is the
lender of last resort.
Lender of last resort. If any bank has a crisis, then the central bank will come and protect that particular bank. And I don't know if any of one of you remember, 5 years back there was a crisis in another bank, ICICI Bank. The biggest private sector bank had almost a bank run problem, which means it was about to collapse. Why? When will the bank be on the verge of collapse?
There were rumors that the
Bank
bank
was
will not safe. There were rumors that the bank is not safe and
banks are not safe. So what is that? It's about take any particular bank. If anybody gets that rumor that this bank is about to collapse, what does the depositors do? And no bank at a particular moment in time can pay back all the depositors. Imagine that how much trust we have. That the entire banking works on trust. And you believe that the bank has the money when you want, and bank actually doesn't have the money. You see the imagination, kind of how the whole system completely depends on trust. As a group, you should be aware that banks never have the money which you have, all of you together. But as an individual, you don't have a problem, you can go and withdraw anytime. That's the kind of a beauty of this entire financial system in the capitalist world. And that's why Lenin, who was a revolutionary in 1917 in Russia, I don't know, I told you the story already. He said if you want to destroy capitalist country or a capitalist system, destroy its money, which means destroy the trust. If you destroy the trust, problem solved, capitalism will be kind of on its knees and it can be converted into whatever you want, socialism or whatever. So that's the way entire thing works. But is there another way you can destroy the money or the trust in the financial system? Which is kind of a, don't need a revolutionary. You just need a stupid dictator. Which has happened now in Latin American countries. What do? They behave so irresponsibly that they created huge amount of deficit and finance through creating money. And they printed so much of it that there was a major crisis, too much money is chasing same number of goods, which you saw in that video the other day. That Spaniards, what they're doing, they thought by getting silver they're getting richer. It's not that. Silver is not the thing. It doesn't matter where you inscribe the number, 10 rupees or 100 rupees or dollar or whatever. It's the trust of that. If the trust is violated, the value of that money is gone. As the value of the money is gone, you are back to the barter system. Because nobody wants the money. They will not exchange their goods and services for money. And if they don't exchange, you have a crisis. And the crisis means your entire division of labor collapses. Entire specialization of production collapses. Which means entire capitalist economy collapses. Is it clear? Maybe you could open some windows. Some people are having. So I hope that's clear. The lender of last resort is a function which was understood for the first time in 1930s. In 1930s, Federal Reserve for the first time understood that if you don't rescue the bank, then the entire financial system will collapse. Why? Because the one bank you allow to collapse, then what will happen? People will lose trust on the other banks also. And as they lose, they come to withdraw, and as they come to withdraw, no other bank will have money. Or you have to have an emergency situation, like the present situation. Federal Reserve has bought toxic assets worth almost $3 trillion, which is more than 3 times that. It's almost 3 times the Indian GDP. It's about half of Chinese GDP. They spent on just to rescue these toxic assets which are there on the balance sheet of the private financial institutions. Why? What was the mistake they did? They allowed Lehman Brothers to collapse. George Bush, you remember, he was the president, and that other guy, Paul. Walker is the guy who was the Treasury Secretary in the previous regime.
Alan Greenspan.
No, he was the head of the Federal Reserve. I'm not talking about the Federal Reserve. No, Paul. I'm forgetting the name. Paul son or something. Henry Paul Goodman. Paul Goodman had warned that if you don't allow the rescue of Lehman Brothers, this kind of problem will happen. He had argued for saving the Lehman Brothers, but it was not understood by those Republicans at that time, and then that led to a lot of the financial crisis. So then the chain reaction started. The reverse of the money multiplier. Money multiplier means money can go up, but if the trust goes away, then you can go the reverse. From 1,000 you become 100. And if you look at the, let me see if I can show you. If you look at the, let me see if the data is here. I'll show you that. In 1930, the money M2, which is M3 in Indian context, in the US went down by almost 50%, and M1 was increased by approximately 50%. But what will happen? M1 is a smaller part, M3 is a bigger part. So what will happen? M3 went down by 50% means suppose M3 was 100, it went down to 50, but M1 is only 25. Even if you double it, it will be 50. So overall still there is a major problem, the liquidity. And that's what happened in the 1930s, and that's what happened in present situation also. A lot of the banks and the financial institutions had the exposure to the subprime. And subprime market, when what happens? I have a house, I bought in the belief that prices will go on rising. Now really prices stop rising. So then what happens? I want to now get rid of it. And when I go to the market, not just me, lot of number of people go to sell. And then what happens? People want to buy, they suddenly say, I will not buy because I don't know price will go down further. So this is the exact same thing happens in the stock market also. The sentiment. And then suddenly if people don't buy, then what happens? The house actually is almost like worth zero. And then how do we finance the house? Borrowing from the banks. So banks freeze up. The bank freezes up. The people from whom bank has borrowed the money. I mean, in this present situation, it was not the banks which was so much of a problem, but it was Lehman Brothers and types who were bigger kind of having exposure. And one of the reasons it happened is that the US in the early 1990s, there was a Glass-Steagall Act which separates the boundaries between banking in companies and the non-banking companies, NBFCs. But this was diluted. And that basically led to a lot of banking institutions getting into non-bank. Citibank, for instance, and Lehman Brothers, and all these places, companies started doing things which normally conventionally banks used to do, which means except deposits, like retail deposits. And that led to they are becoming very big inside compared to the banking system. So your old regulatory mechanism is geared towards banking system, but now these non-banks are also doing the banking job, but they are out of the law. So effectively, there's no CRR, no SRR, anything they are following. There's no insurance on their deposits. And then once they collapse, but they are offering a higher return. So a lot of people are getting guided and putting their money there. And then multiplying working there also. So when anybody collapses there, the entire thing freezes up. And the first thing that happened was with Northern Rock. Northern Rock is a British NBFC. So Northern Rock actually is not a bank. It actually was borrowing money from the market and lending it to various things. It was non-retail. It was like borrowing money from the institutions, and institutions were giving it because it was offering a higher return. So then what happened? Northern Rock, when there was a rumor again that it's going to collapse, so then what happened? People started asking for the money. Now, the Bank of England, the Bank of UK, issued a kind of a statement that Northern Rock is safe, there is no problem. And imagine what happened the next day. Actually, it collapsed. Why? Because people the central bank has to defend this. There is something really wrong there. I mean, that was kind of unprecedented that the central bank is coming out to defend a non-bank financial institution. And that led to the complete collapse of Northern Rock, and Northern Rock became extinct. So that's kind of a trust. What I'm trying to highlight is that trust is very, very important. If you don't have trust, even if you are individually kind of doing that whatever hanky-panky, but you're actually affecting not just yourself, you're affecting the entire financial system. That's where the role of the regulation becomes very, very important. You are talking about super regulator, this, that, RBI, IRDA, all these basically are financial sector. So all these things, they have to be somehow coordinating themselves. If they don't, the problem is the coordination also doesn't work very well, because UK has a super regulator, FSP or something is called, financial sector, I don't remember exact.
Financial Services Authority.
Something like that. So it could not. That's the kind of example which everybody now advocating that you should have something like that. But in UK it didn't work. In US it doesn't. It's not there, but there also things are not very good. And so on and so forth. If you see in India, this thing hasn't been very bad. And now people say, since we have SLR, we don't have any problems because the banks are already safe because we have forced them to be already safe. They are already buying securities which are kind of risk-free. So the exposure to the subprime and all, only one or two banks have, which is ICICI, which is again here also. But overall the exposure was limited because there are all regulations on banks in India. So that becomes like a dilemma for the regulator or the bank. If you have too much regulation, the bank's profitability is less. But risk is less also. The second is, you give them a lot of freedom, then they invest entire money in the stock market. They have a choice. And then what will happen? The risk will be quite a lot, although returns will be very good also. So that's the problem is banks are not playing with their own money. Banks are playing with other people's money. That's why you need to regulate it. That's why in India, across the world, there is something called deposit insurance. Which means whatever deposits you have, it will be insured up to in India up to 1 lakh. But now 1 lakh it was done long time back. But now there is a possibility need to revise it, because if you have more than 1 lakh in a particular bank account, then you are open to risk. But in India, since most of the banks are nationalized, we don't really even bother about these issues. But in other countries, other parts of the world, it's not true. The banks are basically not in the public sector. So effectively, responsibility, again, it seems like the Federal Reserve or European Central Bank or Bank of Japan. The problem is, if you allow one bank to collapse, then the chain starts. Then the entire financial system collapses. Effectively, you are rewarding the basically people who are in the banking institutions to take risk and earn money. But if they kind of don't perform, you are actually rescuing them. And whose money you are using? You are using taxpayers' money. So that's a very big dilemma. Should you allow a systemic risk of collapse of the entire financial system, or should you kind of not allow this? And basically, then maybe your the classic example of the debate comes in. That government is interfering too much. So that's kind of so effectively 1930s onwards we learned about the banking system. But today's crisis has taught us about non-banks also are kind of need to be looked at very carefully. And now what has happened, the result of that, in the US, not only non-banks, these companies and all have been asked to convert themselves to a banking company. The Goldman Sachs and many other people who have survived, they have been now asked to take a banking license. Which means now you will be under the same regulations as a bank. So that these are the issues which kind of go on in this particular context. And now, We come to the money supply, and money supply basically now you see, if you have a more the interest rate, the money supply will be like a rising curve. So this is kind of a money supply curve you will get in a system where the banks are there. If you have no banks, then effectively money in the system is exactly equal to as if banks don't exist, means whatever money I print and central bank, there's only that much money, there's no extra money. That is the system till about 1930, where the printing of money was absolutely, virtually, whatever was required, and there was no this kind of credit creation system was kind of not very encouraged. It was there, but kind of not so, interest rate was not allowed to change and things like that. So it was very stable kind of system, which is what now the Basel III tries to recommend. It is banks should have, if taking any risk, they should have equal amount of capital. Which means if I have 100 amount of my own capital, that means that I can lend only that much. Which means whatever money I am taking from the depositors and all, I cannot put it on any risk. Which means that the entire financial intermediation doesn't work. So that kind of debate is going on, and I don't know where to settle. There's a lot of kind of controversies and all. We have not really come out of the session as yet. And going by the present scenarios built up by a lot of people, it seems we are going to be in for this kind of crisis for longer than we expected it to be. Maybe not India and China, but definitely US is not going to be out very soon. Because I think now the present debate about Obama withdrawing the stimulus package and the Republicans becoming important, there will be a further dilution of the regulation. Which means again you will be prone to the risk, and then you have a come out of the present crisis. So you're talking about withdrawing all those regulations and all. Which means you will be back to square, and then US is going to see something which Japan is seeing for almost 20 years. So a lot of people think that Japan has not been able to teach anything to the Americans. Which means this crisis is going to continue. That's my understanding. Maybe I'm hoping I'm not right. But indications are, I think you can get from your own understanding of the macro picture, what the things look like that. Now we go to the demand side. Demand, why would anybody want money? There are broadly three reasons Keynes proposed, and the theory has not been able to improve on that. Keynes has three reasons people would want cash. Suppose you are taking your own individual perspective. Why do you keep cash with yourself? Why do you keep cash with yourself? You have cash in your pocket? No? Like ask somebody to search your pockets and why do you keep cash in your pocket? To spend. Why? What kind of spending you have in mind? Okay, so basically one is transaction reason. Transaction means buying or selling, or basically buying products. Buy a pen, maybe buy a burger, maybe buy a coffee. That's first reason. What would be the second reason you will keep cash? Yes, to make money. Again, that would be speculative. There's one more reason you may want to keep cash with you. Any kind of a eventuality or security. It's called the precautionary reason. So these are the three reasons where people claim that people demand money. And what will transaction demand for money will depend on? Will be a function of? Whatever cash you have in your pocket for transaction purposes will depend on what?
Disposable income. Disposable income.
Income is the only context you can think of anything else. One is income, disposable income or GDP, whatever you call it. That's fine. Prices. What happens if the prices go up?
decrease this percentage. So
You will keep more cash or less cash?
less cash.
Huh?
Less cash. Same thing, but less cash.
Less cash. Now actually it's a very dynamic question. Because the thing is, if inflation is within a certain limit, you will have to keep more. But if it goes beyond certain limit, like hyperinflation, then actually you don't want to be very cash. You see, that's the problem with inflation. If inflation is moderate, suppose it goes up from 2% to 4%, you need to give little extra cash. And you will keep that. Because you have to buy coffee beans, suppose coffee became 4 rupees, 5 rupees, you have to keep 5 rupees. But suppose coffee became 500 rupees, what will you do? You will not keep cash with you, you will keep something else, maybe a commodity or something. Maybe a gold, some kind of a, or something, some other, which is value not going down. Because if the cash is losing its value, then basically it may be a good idea for you to keep something else. Is it clear? So inflation, that's why we don't really, so it's a kind of a both-way thing. Or you can say, why it has been built? We call it P into Q. Price into real GDP. Anything else you think depends on? Interest rate. Okay, let's debate about interest rate. So this is positive. If the interest rate goes up, will your money demand go up? Transaction process. Suppose RBI yesterday raised the interest rate. Does your requirement for coffee goes up or goes down? So RBI raised the interest rate, maybe you should not have coffee.
Not matter.
Is it affected? No, let's go by one. It is all three. Yes. Yes, you're saying something.
For loans,
No, loans will be third part. That will come later. I'm saying transactionary purposes. You want to buy coffee or you want to buy a soap or a pencil or pen. Does your RBI interest rate affect your decision? It doesn't. So, but example, interest rate becomes very high. Maybe on the margin, little bit. Instead of suppose you buy 2 or 3 coffees, maybe you will buy one less. But I mean, not very significant. So if I have to draw a graph, again rate of interest and demand for money, it will be something like this, but maybe slightly like this. Or slightly falling rather. If the rate of interest is high, it will be something like this one, not the other side. Something like this. Because at a very high rate of interest, then even keeping idle cash maybe not a good idea. Because you are losing a very high interest rate. So maybe little bit you reduce your, like give me an example, I think I gave you an example in the last class. When there was hyperinflation in Germany in the interwar period, the workers were paid salary twice a day. Twice a day. As in you go work for 4 hours, you get your salary. Again, what you do in the lunch time, what you do with the cash you got? You quickly go and buy something. Because cash is losing value. And then evening again you are paid. So again you go and buy something because you don't want to keep cash. That's the kind of a context I'm talking about. What about precautionary? More or less same. If your income is high, you keep more cash balances for precautions. A person who is poor will keep less. Rate of interest again more or less same. So I can say this is both precautionary and transactionary demand for money. Now next comes the speculative demand for money, which is actually a lot of people have in mind. It's for speculation, that means to take advantage of the rate of interest. So suppose the rate of interest is very low, like Japan. Japan is interest close to 0. So, will you keep cash with yourself or will you keep money in the bank?
Keep cash.
And if you keep your money with yourself, basically, you have a lot of cash, what demand for what you have? Your place where to keep cash, isn't it? In your home. So, Godrej found a very big market in Japan in the last 20 years. Because people are buying, Godrej is very famous world over for making those safes where basically you can keep your liquid cash. So in Japan, a lot of those things are getting sold because the interest is 0, people are not willing to keep money in the bank, and that is basically the outcome. Now something similar is going to happen to US. So the speculative part for money, if the interest is high, will be very low because you don't take much advantage of the rate of interest. So the rate of interest is 15%. Then basically for you it is not a point to keep idle cash because you are losing 15%. So if you were to draw a graph, it will be something like, and it will become a kind of parallel here. at a very low rate of interest, suppose R0 is close to 0, this will become infinite. And this is known as the liquidity trap. Amazingly, this was written in 1936 book.